Hello and welcome to RichInsider. Today we're going to discuss a crucial topic that will potentially shape the future outlook of the global economy, including interest rates and job markets. Before we dive into the subject, if you're new here, consider subscribing to our channel to stay in the loop and get notified when we publish new content. America's inflation is showing signs of cooling down after hitting record high in the recent years. In order to combat inflation, the Fed raised interest rates, and in June 2022, the borrowing rates had peaked at a 41-year high of 9.1%. The United States, with its colossal economic footprint, holds significant sway over the global financial system. When the US economy sneezes, the world catches a cold, or so the saying goes. This was evident in the recent days, when there was a worldwide sell-off in the stock market after a weaker-than-expected job report in the US raised fear of an economic recession. What does this essentially mean? It simply suggests that the US economy is in much worse shape than previously believed. As the world's largest economy and a major consumer of goods and services, shifts in US inflation rates reverberate across the globe, influencing exchange rates, commodity prices, and investment decisions. This interconnectedness is particularly evident when we consider the impact of US inflation. The recent cooling of inflation in the US, therefore, has captured the attention of economists, policymakers, and businesses worldwide. After reaching a record high in 2022, inflation has been steadily declining, prompting discussions about its implications for the global economy and job markets. Is this a temporary reprieve or a sign of a more sustained period of price stability? What did the recent Fed meeting hint about the American economy and the domino effect it has on the global economy? But is the US heading for a recession? Come, let's find out in this video. Do watch it until the end so that you get the full picture of what's going to happen. We will also explore into the multifaceted implications of America's cooling inflation, exploring its impact on global exchange rates, commodity markets, international trade, and foreign direct investment, and how it might reshape job markets, potentially influencing hiring practices and outsourcing decisions. Finally, we'll consider the sustainability of low inflation and the potential risks and opportunities it presents for the global economy. Understanding these dynamics is crucial for investors, businesses, and daily workers alike, as we navigate the evolving and struggling landscape of the global economy. By analyzing the ripple effects of America's inflation trajectory, we can gain valuable insights and stay informed about the upcoming events that will shape the future of global growth and prosperity. Inflation, a term that strikes fear into the hearts of consumers and policymakers alike, is simply a general increase in the prices of goods and services in an economy over a period of time. Inflation can have far-reaching consequences, eroding purchasing power, distorting investment decisions, and fueling social unrest. Imagine going to the grocery store and finding that the price of your usual loaf of bread has doubled. Your salary hasn't changed, but suddenly your money buys you less. This is the insidious nature of inflation. It silently chips away at the value of your hard-earned money. Economists use various measures to track inflation, with the Consumer Price Index, CPI, being one of the most widely recognized. The CPI measures the average change in prices paid by urban consumers for a basket of consumer goods and services such as food, housing, transportation, and healthcare. By tracking the CPI over time, economists can gauge the rate of inflation and its impact on consumers' purchasing power. Inflation can be driven by a multitude of factors, including supply chain disruptions, rising energy costs, increased consumer demand, and government policies. Understanding these drivers is crucial for policymakers to implement effective measures to control inflation and maintain economic stability. The US economy has been grappling with a surge in inflation since early 2021, reaching levels not seen in 4 decades. This inflationary surge was fueled by a confluence of factors, including supply chain disruptions caused by the COVID-19 pandemic, soaring energy prices exacerbated by the war in Ukraine, and robust consumer demand fueled by government stimulus measures. However, recent data suggests that the US is finally turning the corner on inflation. The Consumer Price Index, CPI, has shown a steady decline since peaking in mid-2022, indicating a cooling of price pressures. Several factors have contributed to this positive trend. Firstly, supply chains have begun to untangle, easing bottlenecks and reducing input costs for businesses. Secondly, the Federal Reserve's aggressive interest rate hikes have started to curb consumer demand, cooling down the overheated economy. Lastly, energy prices have retreated from their highs, providing some relief to consumers and businesses alike. While the recent easing of inflation is undoubtedly welcome news, it's important to note that core inflation, which excludes volatile food and energy prices, remains elevated. This suggests that underlying inflationary pressures persist, requiring continued vigilance from policymakers. The cooling of US inflation and the increase in unemployment rate has significant implications for the global economy, particularly in terms of exchange rates and commodity prices. As the US dollar is the world's reserve currency, changes in US monetary policy and inflation rates reverberate across the global financial system. When US inflation rises, the Federal Reserve typically raises interest rates to cool down the economy. Higher interest rates make US assets more attractive to foreign investors, leading to an appreciation of the US dollar. Conversely, when US inflation cools and interest rates stabilize or decline, the US dollar tends to depreciate. But perhaps the US Fed kept interest rates high for way too long. September 18th is the next scheduled date for the Fed interest rate decision, but some experts point that the Fed's next meeting scheduled for September may be too late, and it may be forced to make an emergency rate cut before then. This is particularly concerning for businesses where slow hiring may turn into rampant layoffs. While a stronger US dollar makes imports cheaper for American consumers, potentially dampening inflationary pressures further, it also makes US exports more expensive for buyers using other currencies, potentially impacting American businesses that rely on international markets. Moreover, changes in the US dollar's value can impact commodity prices, as many commodities are priced in US dollars. A stronger dollar often leads to lower commodity prices, while a weaker dollar can push commodity prices higher. This is because a stronger dollar makes it more expensive for buyers using other currencies to purchase commodities, potentially reducing demand. The cooling of US inflation and its impact on the US dollar have profound implications for international trade, influencing the prices of imports and exports and potentially reshaping global trade flows. As discussed earlier, a stronger US dollar makes American exports more expensive for buyers using other currencies. This can make American goods less competitive in the global marketplace, potentially harming US businesses reliant on exports. Conversely, a stronger dollar makes imports cheaper for American consumers, potentially leading to an increase in imports and a widening of the US trade deficit. These shifting trade dynamics can have significant implications for US trade relationships with key partners. For instance, a stronger dollar could exacerbate trade tensions with China, as it makes Chinese goods more competitive in the US market, while making American goods more expensive in China. On the other hand, a stronger dollar could benefit US consumers by making imported goods from countries like Mexico, Canada, and the European Union more affordable. In conclusion, Fed's lower interest rates in September could help lower punishingly high car loan rates, mortgage rates, and other consumer loan costs. However, it would also mean that people with money in savings accounts could yield less returns in the coming months. At this point, modest economic activity is the path we appear to be on, and there don't seem to be signs of serious recession yet. Do you think we will hit recession in 2025? What do you think will happen to the global economy? Let us know your thoughts and insights in the comments below. We'd love to see you join us in the conversation. Until next time, take care.